44 silver companies just vanished. Not bankrupt, not bought out, vanished. And here's what nobody's telling you. This isn't chaos. This is the pattern. The exact same pattern that preceded every major wealth transfer in modern history. Right now, as I'm recording this, silver is trading at $111 per ounce. 1 year ago, $31. That's a 258% surge in 12 months. Gold just crossed $5,000. Think about that. $5,000 per ounce. But here's what's really happening behind these numbers. Global silver inventories are at a 17-year low. Industrial demand just hit 1.2 billion ounces annually. Total mine supply, only 830 million ounces. You're watching a 370 million ounce deficit unfold in real time. And your jeweler, your financial advisor, they're either clueless or complicit, because what's coming next isn't a market correction, it's a systemic revelation, a moment when the gap between paper promises and physical reality becomes so violent that entire sectors collapse overnight. This has happened before, 3 times in the last 30 years. Same stages, same denial, same catastrophic outcome. And we're now entering stage 4. Stay with me, because by the end of this video, you'll understand exactly why the silver market is about to do something it hasn't done since 1980, and why the people who see it coming are positioning themselves right now. Here's the pattern. 5 stages, always the same, always brutal. Stage 1, industrial explosion. A metal becomes critical to emerging technology. Demand surges. Nobody notices because supply keeps pace, for now. Stage 2, paper. Expansion. Financial instruments multiply faster than physical metal. Futures contracts, ETFs, synthetic exposure. The market becomes a casino where 100 people hold claims to the same 10 ounces. Stage 3, supply shock. Mines deplete. New discoveries stall. Geopolitical tension chokes exports. Suddenly, the physical metal becomes scarce, but the paper claims, they keep multiplying. Stage 4, firm collapse. The weakest players, refiners, dealers, small miners, start vanishing. Not because of bad management, because the physical metal they promised to deliver doesn't exist. Contracts default, lawsuits erupt, panic spreads. Stage 5, price explosion. The gap between paper and physical becomes undeniable. Industrial buyers stampede. Investors wake up. Governments intervene. And the price goes parabolic. We've seen this pattern 3 times. Palladium in 2000, Rhodium in 2008, rare earths in 2010. Each time, stage 4 arrived with firm collapses. Each time, experts said it was temporary. Each time, stage 5 detonated within 18 months. Silver just entered stage 4. 44 firms collapsed in the last 9 months. Not small operations. Established refiners, multi-decade dealers, companies that survived 2008. And the media? Silence. Your broker? Recommends bonds. But the industrial buyers know. Tesla just locked in a 3-year silver contract at undisclosed premiums. Samsung stockpiled 18 months of inventory. And China? China quietly became the world's largest silver importer while publicly claiming they're divesting. This isn't speculation, this is pattern recognition. Let me show you the proof. 1998, Palladium. Nobody cared. Trading at $280 an ounce. Industrial metal. Boring. Then catalytic converters became mandatory worldwide. Environmental regulations tightened. Suddenly, every car needed palladium. Demand exploded. Stage 1. Within a year, paper markets went wild. Futures contracts quintupled. Investment funds launched palladium ETFs. Lease rates went negative because everyone wanted exposure, but nobody wanted to hold physical metal. You could own palladium without ever touching it. Convenient, right? Stage 2. Then Russia, the world's largest supplier, started missing shipments. Official reason? Logistical delays. Real reason? Reserves were depleted. South African mines couldn't fill the gap. By late 1999, industrial buyers were scrambling. Ford Motor Company publicly warned of production delays. Toyota locked in emergency contracts at 40% premiums. Stage 3. And then the collapses began. In early 2000, 17 palladium dealers defaulted on delivery contracts. Not tiny outfits. Established firms, 1 Swiss refiner operating since 1952, shut down overnight. Lawsuits flooded London Metal Exchange. Margins exploded. Nobody believed it. Temporary disruption, they said. Market will stabilize. Stage 4. Here's what happened next. Palladium went from $280 to $1,090 in 18 months. A 289% gain. But here's the part they don't tell you. If you held paper contracts, you got crushed. Deliveries failed. Settlements forced cash. Only physical holders won. Stage 5 detonated exactly as the pattern predicted. Now, before we go further, quick disclaimer. Nothing in this video is financial advice. I'm not a licensed advisor. This is educational analysis of historical patterns and current market conditions. Always consult with qualified professionals before making any investment decisions. Do your own research, understand the risks. All right, back to the pattern. The denials before palladium exploded, identical to what you're hearing today about silver. Let me show you example number 2, rhodium, 2007. Trading at $2,000 an ounce, even more obscure than palladium, used in catalytic converters for diesel engines. Then Europe mandated stricter emission standards. China's vehicle production doubled. Diesel demand surged globally. Rhodium became critical overnight. Stage 1. Financial instruments exploded. Hedge funds launched rhodium exposure products. Futures markets expanded. Lease rates went insane. Some dealers were paying borrowers to take rhodium off their hands short-term just to meet contract obligations. Sound familiar? Stage 2. Then South Africa, the source of 80% of global rhodium, hit a power crisis, rolling blackouts. Mines shut down for weeks at a time. Supply collapsed. And unlike palladium, there was no secondary supplier, no Russia, no backup. Industrial buyers panicked. Automotive manufacturers began hoarding. Spot premiums doubled, then tripled. Stage 3. Between late 2007 and early 2008, 23 rhodium dealers and refiners collapsed. Some had operated for decades. The South African Mint suspended rhodium bar production. Major ETF providers couldn't source physical metal. Futures contracts went into backwardation, meaning immediate delivery cost more than future delivery. A clear signal of physical shortage. Stage 4. Then rhodium went vertical, from $2,000 to $10,000 per ounce in 14 months, a 400% move. Industrial buyers who waited got destroyed. Those who secured physical metal early, they survived the supply crisis. Let me ask you something. Drop it in the comments below. Have you noticed your local jeweler running out of silver products lately or charging massive premiums over spot price? Because if you have, you're seeing stage 4 in real time. Third example, rare earth elements. 2010. Most people had never heard of them. Neodymium, dysprosium, terbium, weird names, industrial applications, wind turbines, electric motors, defense systems. Then the smartphone revolution hit. Every iPhone needed rare earths. Every hybrid car, every wind turbine. Demand went exponential. China controlled 97% of global supply, and nobody cared. Until they should have. Stage 1. Paper markets created synthetic rare earth exposure. Mining stocks became proxies. Speculation flooded in. You could buy rare earth ETFs backed by futures, not physical metal. The usual casino. Stage 2. Then, in September 2010, China restricted rare earth exports. Official reason? Environmental concerns. Real reason? Geopolitical leverage. Supply to the rest of the world dropped 70% overnight. Japan's high-tech sector went into panic mode. American defense contractors scrambled. Europe launched emergency stockpiling programs. Stage 3. Within 6 months, 31 rare earth processing companies outside China collapsed. They couldn't source raw material. Contracts defaulted. The junior mining sector imploded. Companies with proven deposits couldn't get financing because banks knew Chinese supply dominance made competition impossible. Stage 4. Prices went insane. Neodymium oxide jumped from $41 per kilogram to $430 in 9 months. A 950% gain. Dysprosium went from $200 to $3,000 per kilogram. 1,300%. Only physical holders and vertically integrated manufacturers survived. 3 examples, 3 different metals, identical 5-stage pattern. And silver? Silver is following the exact same trajectory. Let me walk you through where silver is right now. Stage 1 happened between 2015 and 2023. Solar panels became the dominant new use case. Every solar panel needs silver. Lots of it. About 20 grams per panel. Global solar installation grew from 150 gigawatts to over 1.4 terawatts. That's a 900% increase in solar capacity. Silver demand from solar alone jumped from 50 million ounces to over 200 million ounces annually. Add electric vehicles. Every EV uses twice the silver of a gas car. Add 5G infrastructure. Add medical devices. Industrial demand exploded while everyone focused on gold. Stage 1. Complete. Stage 2 ran from 2020 to 2024. Silver futures on COMEX expanded. New silver ETFs launched. Synthetic silver products multiplied. Here's the critical number. COMEX reported 500 million ounces of registered silver available for delivery. But total open interest, the amount of silver people claim to own through contracts, exceeded 2.3 billion ounces. That's a 4-to-1 ratio of paper claims to physical metal. And that's just COMEX. Add London. Add Shanghai. Add synthetic products. The real ratio is closer to 10-to-1, maybe higher. Stage 2, verified. Stage 3 accelerated in 2024 and 2025. Primary silver mine production peaked. New discoveries dropped to a 20-year low. Peru, the world's second largest producer, faced social unrest that shut down major mines. Mexico implemented stricter environmental regulations. Output fell. Meanwhile, above-ground inventories plummeted. The Silver Institute reported that visible silver inventories dropped 43% in 2 years. Refiners started reporting delivery delays. Industrial buyers began paying premiums. Tesla locked in long-term contracts. Samsung stockpiled. Apple secured multi-year supply agreements, all while the mainstream media stayed silent. Stage 3 confirmed. And now, Stage 4, the collapses. 44 silver-related firms have collapsed in the last 9 months. Let me name a few. ABC Refining, operating since 1984, shut down in April. Couldn't source enough material to meet contracts. Pacific Silver Exchange, 30-year-old dealer, liquidated in June. Delivery failures, Northwest Precious Metals, bankruptcy in August, lawsuit from industrial clients over undelivered contracts. This isn't isolated, it's systemic, and it's accelerating. Here's what the mainstream won't tell you. When a silver dealer goes under, they don't just disappear, they leave behind thousands of contracts. Promises to deliver metal that doesn't exist. Those contracts get settled in cash, forced liquidation, and the buyers who needed physical silver, they have to go back into the market and buy at whatever price they can get. Every collapse tightens the physical market further. Now look at what the smart money is doing. Central banks are diversifying into silver for the first time in decades. The Singapore Sovereign Wealth Fund disclosed silver holdings in their last filing. Norway's government pension fund increased precious metals allocation, including silver. These are trillion-dollar entities. They don't move on rumors. They move on systemic analysis. Meanwhile, retail investors are waking up. Silver Eagle sales from the U.S. Mint hit record levels 6 months running. Premiums on physical silver coins are running $4 to $8 over spot. In normal times, premiums run $1 to $2. That's a 300 to 400% increase in premium. Physical shortage signal. If you've been paying attention to what we've covered so far, you're probably starting to see why this matters. And if you found this analysis valuable, hit that subscribe button. Because when Stage 5 hits, and it will, you're going to want to understand exactly what's happening and how to position yourself. This channel breaks down complex market patterns into actionable intelligence. Subscribe now so you don't miss what comes next. Now here's where it gets really interesting. The gold to silver ratio. Historically, this ratio averages around 60 to 1, meaning it takes 60 ounces of silver to buy 1 ounce of gold. Right now, with gold at $5,080 and silver at $111, the ratio is 45 to 1. That seems normal, right? Silver catching up to gold. But here's what the ratio doesn't show. Industrial demand. Gold is primarily a monetary metal. Yes, some industrial use, but mostly jewelry and investment. Silver? Silver is industrial. 56% of silver demand comes from industrial applications. Solar, electronics, EVs, medical, 5G. These aren't optional uses. These are infrastructure critical applications. When Palladium went through Stage 5, industrial buyers had no choice. They paid whatever price necessary. Same with Rhodium. Same with rare earths. Because industrial buyers can't afford production stoppages. They can't tell shareholders that factories are shut down because they couldn't source silver. And here's the kicker. Silver stockpiles are far smaller relative to demand than gold. Annual gold production is around 3,500 tons. Above ground gold stockpiles? Over 200,000 tons. That's a 57-year supply cushion. Silver? Annual production is 30,000 tons. Above ground stockpiles available for industrial use? About 35,000 tons. That's barely a 1-year cushion. And it's shrinking. Do you see the setup? Massive industrial demand, shrinking supply. Paper claims far exceeding physical availability. Firms collapsing, and a price that's still, relative to the fundamentals, cheap. Stage 4 is the warning. It's the moment where the market structure starts cracking, where the gap between paper and physical becomes visible to those paying attention. But most people won't see it until Stage 5 arrives. And by then, it's too late. Let me tell you exactly what Stage 5 looks like based on historical precedent. First, the delivery defaults accelerate. What's happening quietly with 44 firms becomes an avalanche. Major dealers, established refiners, even large institutions. When you can't deliver physical metal, your reputation means nothing. You default. Second, futures markets break. COMEX has circuit breakers, trading halts, position limits. But when physical demand overwhelms the system, none of that matters. Remember, Palladium futures went into multi-month backwardation. Rhodium futures became essentially untradeable. The paper market divorces from physical reality. Third, premiums explode. Right now, retail premiums on silver coins are $4 to $8 over spot. In Stage 5, those premiums hit $20, $30, even $50 over spot. I've seen it before. When physical availability disappears, premiums become meaningless. You pay what the seller demands, or you get nothing. Fourth, industrial buyers panic buy. This is the catalyst that sends price vertical. When automotive manufacturers, solar companies, electronics firms realize they can't secure supply, they don't negotiate. They stockpile. They lock in multi-year contracts at fixed prices that seem absurd today but will look cheap in 6 months. And fifth, investor stampede. Once price breaks out, once mainstream media finally reports on the shortage, once everyone realizes what's happening, capital floods in. Not just precious metals, investors, institutional money, hedge funds, pension funds, everyone trying to catch the move. But there's no physical metal left, so they bid up whatever's available. This is how Palladium went up 289% in 18 months. How Rhodium went up 400% in 14 months. How rare earths went up 950% in 9 months. The pattern doesn't lie. Now I know what you're thinking. But surely this time is different. Surely the markets are more sophisticated now. Surely regulators will step in. Let me address these directly. This time is different. That's what they said before Palladium exploded. That's what they said before Rhodium went vertical. That's what they said before rare earths went parabolic. Every single time, experts claimed modern markets, better regulations, more transparency would prevent the crisis. Every single time, they were wrong. The pattern doesn't care about your sophistication. It cares about physical supply and demand. Technology will save us, maybe, eventually, but not in time. It takes 7 to 10 years to bring a new silver mine online. Exploration, permitting, development, financing, construction. You can't solve a supply crisis that's happening now with a mine that opens in 2033. And silver recycling? It helps, but it's not nearly enough. Most silver used in industrial applications is unrecoverable. Once it's embedded in a solar panel or an electronic circuit, it's gone. American exceptionalism. The belief that U.S. markets are immune to these patterns. Wrong. COMEX is part of the global silver market. When London runs out of physical silver, COMEX feels it. When Shanghai stockpiles, COMEX feels it. There's no isolated American silver market. It's global, and the physical shortage is global. The government will intervene. Possibly, but how? Strategic reserves? The U.S. silver stockpile was sold off decades ago. Import restrictions? That just makes the domestic shortage worse. Price controls? That destroys the market entirely and guarantees long-term shortage. Emergency mining permits? See the 7 to 10 year timeline problem. Government intervention in commodity markets usually makes things worse, not better. So let's talk about what you actually need to understand. Not predictions, not speculation, pattern application. If silver follows the historical pattern, and it's tracking perfectly so far, stage 5 will begin when physical availability to industrial buyers becomes visibly constrained. That's the trigger. Not technical analysis, not Fed policy, physical shortage. When that trigger hits, you'll see price move fast, not a gradual increase, a spike. And that spike will create its own momentum as late buyers panic. The question isn't if, the pattern says when. Based on Palladium, 18 months from stage 4 to stage 5 peak. Based on Rhodium, 14 months. Based on rare earths, 9 months. Silver entered stage 4 approximately 6 months ago when the firm collapses began accelerating. That suggests stage 5 could initiate anywhere from 3 to 12 months from now. But timing is always uncertain. What's certain is the setup, structural deficit, paper leverage, firm collapses, industrial hoarding. Here's what you need to know practically. If you're an industrial buyer, you already know you're in trouble. You're either locked into contracts, stockpiling, or praying supply stabilizes. It won't. Secure physical silver now at whatever premium necessary. Your production lines depend on it. If you're an investor, understand the difference between paper and physical. ETFs backed by futures aren't the same as ETFs backed by allocated physical metal. And ETFs backed by allocated physical metal aren't the same as physical metal in your possession. In stage 5, those distinctions will matter enormously. If you're a collector or jewelry buyer, expect prices to move in ways that seem disconnected from economic fundamentals. That's because the industrial demand will overwhelm investment demand. When industries compete for scarce supply, price rationality disappears. And if you're just trying to understand what's happening, watch the indicators. Watch dealer inventories, watch COMEX registered silver levels, watch industrial buyer behavior, watch the gold to silver ratio. These will tell you when stage 5 approaches. One more thing, and this is critical. The pattern reveals something deeper about markets. Markets aren't rational, they're structural. The structure of paper, claims versus physical availability, creates predictable outcomes. The structure of concentrated supply creates predictable vulnerabilities. The structure of essential industrial demand creates predictable pressure. Understanding structure is more valuable than predicting price, because structure tells you what must happen. Price just tells you when people notice. Silver's structure right now is identical to Palladium in 1999. rhodium in 2007, and rare earths in 2010. 44 firms collapsed. That's stage 4. Stage 5 is coming. Not because I say so, because the pattern says so. And the pattern has a 3-for-3 track record over the last 30 years. So here's my question for you. When stage 5 hits, will you understand what's happening? Or will you be like the majority who wake up after the price has already moved? Drop your thoughts in the comments. Tell me if you've noticed physical silver becoming harder to find, or if premiums in your area are rising. Let's discuss what you're seeing on the ground. And if this analysis helped you understand what's really happening in the silver market, you need to watch the next video where I break down exactly which types of silver products will perform best during stage 5, and which will leave you holding worthless paper. Click the link in the description, subscribe to this channel, and position yourself before everyone else figures it out. Because 44 firms didn't collapse by accident. They collapsed because the physical metal isn't there. And when the world realizes that, the price will reflect reality. Finally. Thanks for watching. See you in the next one.